Do you own your home? If you do, and you've been in it for more than a few years, you're likely sitting on a significant amount of equity. Here's the question most homeowners never ask. What is that equity actually doing for me right now? Is it just sitting there, not growing, not generating income, not working? Then you're leaving one of the most powerful financial assets completely idle. Today, I'm going to show you a strategy that sophisticated investors use to take the dormant equity and put it to work in a capital real estate investment that generates real consistent returns. If you haven't heard about it, it's called a HELOC, Home Equity Line of Credit. It's the third and final vehicle in our CRE Capital series. My name is Jroma. I'm the owner of CA Real Estate Investments, and this is video 3 of my 3-part series. If you missed videos 1 and 2, the SDIRA and the solo 401k breakdowns, links are in the description to check out. Well, let's get into it. No hype, no fluff, just structure and math. What is a HELOC? Let's start with the basics. A HELOC, a home equity line of credit, is a revolving line of credit extended by a lender against the equity you've already built in your primary residence. Think of it like a credit card, but secured by your home at a much lower interest rate. You're approved for a maximum credit limit based on your home's value minus your outstanding mortgage balance. So you can draw from it when you need it. You repay it and you can draw again. Okay, during the draw period, typically 5 to 10 years, you have flexibility to access that capital. Unlike a home equity line, which gives you a lump sum at a fixed rate, a HELOC is a revolving facility. So you only pay interest on what you actually draw. And as a real estate investor, that flexibility is a significant advantage. Why most homeowners never use this? Here's the pattern I see constantly. A homeowner has $150,000, $200,000, or even $300,000 in home equity. That equity is sitting completely idle. It's not generating income. It's not compounding. It's just there, trapped in the walls of a house. Meanwhile, that same homeowner is watching commercial real estate deals go by, assuming they don't have any capital to participate. But the capital is there. It's just in the wrong form. The reason most homeowners never deploy their equity is simple. They've been taught that their home equity is a safety net and not a tool. Listen, I'm not saying to ignore the risk. The risk is real and we'll cover it in detail, but I'm saying that the most financially sophisticated households in the country treat home equity as a working asset, not a passive one. And the HELOC is exactly how they access it. So here's the process, straightforward and practical. So step 1, determine your available equity, right? Most lenders allow you to borrow up to 80 to 85% of your home's combined loan to value ratio, meaning your mortgage plus your HELOC cannot exceed 80 to 85% of your home's appraised value, right? So example, your home's worth $500,000 and the lender, again, will allow 85% of this, so that's $425,000. Your mortgage balance, say, is $250,000, so just subtract $425 from $250,000 at 85%. You could access up to $175,000 in a HELOC, okay? Step 2, apply with your bank or credit union. The approval process looks at your credit score, your income, and your loan to value ratio. Most HELOCs will close in about 2 to 4 weeks. Step 3, draw what you need. Once approved, you draw the capital you want to deploy. So let's say $100,000. You don't pay interest on the unused portion. Okay, so step 4, invest as an LP in a CAE deal. The HELOC funds your LP investment. The deal goes to work generating returns without you doing anything. So step 5, service the HELOC from the deal distributions or your current cash flow. The preferred return from the deal can offset a significant portion of your borrowing cost. We'll look at that math in a moment. So let's run the numbers. because this is where it gets interesting. So here's a scenario. You draw $100,000 from a HELOC at, say, a 6.5% variable rate. Your annual interest cost on that draw is approximately $6,500. You invest that $100,000 as a passive LP in a CAE self-storage deal at 8% preferred return. So your annual preferred return income is $8,000. So your net cash return in that year one, hypothetically, is approximately $1,500. For no money out of your pocket and a gain of $1,500, you have deployed $100,000 into a commercial real estate deal that is generating regular preferred returns, building equity through property appreciation and positioning you for an equity distribution at exit. Now, this is not a guaranteed arbitrage. It's a calculated deployment of that idle capital into a productive asset with a cost structure that makes it accessible to homeowners who would otherwise be sitting on the sidelines. There's also a tax dimension to the HELOC strategy worth understanding, okay? So HELOC interest may be tax deductible when the borrowed funds are used to invest in income-producing properties. So this is a nuanced area of tax law, and the rules have changed in recent years, so this is absolutely a conversation to have with your CPA before proceeding. But the general principle, if your HELOC proceeds are deployed into an investment that generates income, the interest you pay on the HELOC may be deductible as an investment expense. That's amazing. That deduction, if it applies to your situation, further reduces the effective cost of your borrowing. Additionally, as a passive LP investor in a commercial real estate syndication, you may receive depreciation pass-throughs from the deal as well. Depreciation is a non-cash deduction that can offset taxable income from the deal's distributions. Again, a CPA conversation first for sure. But the tax picture for a HELOC funded LP investment can be significantly more favorable than it appears on the surface. So what are the risk factors? I want to spend a full minute here because I think this is where a lot of financial content fails people. So the HELOC strategy carries a materially different risk profile than the SDIRA or the solo 401k that we covered. Here's what you need to understand clearly before you proceed. Risk one, your home is the collateral. If the investment underperforms and you cannot service the HELOC, the lender has a claim on your home. This is not a hypothetical risk. It is the defining risk of this strategy. Risk two, variable interest rates. Most HELOCs carry variable interest rates. If rates rise significantly, your borrowing cost increases, and the math we discussed a little earlier becomes less favorable. Risk three is liquidity, right? Real estate syndications are illiquid. Your capital is typically locked for 3 to 7 years. You cannot draw it back to service the HELOC if circumstances change, right? And risk four is deal performance, obviously. So preferred returns are not guaranteed. If a deal underperforms, distributions may be reduced or delayed. I'm not representing this strategy as a low risk move at all. I'm representing it as a strategy that is appropriate for homeowners with strong, stable monthly cash flow, a risk tolerance that accommodates the possibility of underperformance, a clear understanding of the deal they are investing in, and a qualified CPA and financial advisor in their corner for sure. If that describes you, this strategy is worth a serious look. Let's bring this one home, literally. Okay, so CAE Real Estate Investments acquires and repositions self-storage facilities in the eastern United States through private LP syndication structure, okay? A HELOC investor who deploys $100,000 into a CAE deal receives an 8% preferred return distributed regularly back to the investor. And then also an equity position that participates in appreciation at sale or refinance. And a completely passive investment. No management, no tenant calls, no active involvement. The preferred return distributions can be used to service the HELOC interest, making the net annual cost of the strategy minimal in favorable conditions. And then at exit, the equity distribution provides capital return and upside. capital that can be used to pay down or retire the HELOC entirely. All right, so the cycle is access idle equity, deploy it into a productive asset, let the asset generate returns, exit, retire the debt, and then keep the upside. That's the HELOC strategy applied to a real deal. All right, we covered all three vehicles now. So the SDIRA in video 1, the solo 401k in video 2, and today I covered the HELOC. So 3 things before you go. Number 1, if you haven't watched videos 1 and 2, go watch them. The full CRE Capital series is now complete on this channel. Each vehicle is designed for a different investor profile, and understanding all 3 will help you identify which one fits your situation. All right, number 2, comment the word HELOC below or grab the link in the description and I'll send you the full CRE Capital Playbook. It's a PDF that covers all 3 vehicles in institutional detail. So limits, tax treatment, restrictions, side-by-side comparisons, and a decision framework. It's free, takes 15 minutes to read, and it may change how you think about capital that you already own. And number 3, if you are a homeowner with equity, a self-employed professional with a 401k, or somebody sitting on an old IRA or 401k, and you want to talk about whether a CAE deal makes sense for your situation, just book a 30-minute call. The link's in the description. You can also find the link in my bio. So no pitch, no pressure, just an honest conversation about whether it's a fit. So I'm Jeff Roma. This is CAE Real Estate Investments. No hype, no fluff, just structure and math.